This week, we're breaking down the big stock moves from the trading week ending June 26th, and then we'll dig into a few individual names that saw serious action to figure out whether the market got it right or wrong. Hey, welcome back to MarketSnap. Let's start with the broad picture. It was a split-screen week for the major indexes. The Dow Jones Industrial Average eked out a tiny gain, up about 0.2%. The Russell 2000, the small-cap index, did a little better, up nearly 1%, but the S&P 500 fell 2.5%, and the Nasdaq Composite got hammered, dropping nearly 4.8%. That's a clear rotation out of growth and tech into more defensive or value-oriented names. The weakest sectors by far were basic materials, energy, and technology, all down more than 3%. Industrials and utilities also fell. On the flip side, healthcare was the only major sector in the green, up about 1%. Real estate, financial services, and consumer defensive held up relatively well, losing less than 1%. So this wasn't a broad panic. It was a tech-led sell-off, with money moving towards safety. Looking under the hood, the leading industries this week tell a story of niche strength. Asset management globally jumped over 23%. Environmental services jumped nearly 18%. And business equipment and supplies gained over 10%. Home improvement and medical diagnostics and research also did well. Among large caps, defensive names like Coca-Cola rose over 2.5%, Verizon and AT&T were up, and Uber surged over 5%. But the big losers were concentrated in tech and financials. Cerebras Systems fell over 23%, Jefferies dropped over 21%, Oracle lost over 18%, and MicroStrategy preferred shares fell about 18%. Earnings season so far has been mixed. About 64 companies have reported, with 14 beats and 8 misses, but a lot of names are still pending. The market seems to be punishing guidance misses and rewarding only the strongest results. The macro backdrop is still dominated by the Fed's hawkish tone. Headlines this week talked about bears on both Wall Street and Main Street, as markets digest that bias, with June payrolls coming up. Fed's Kashkari projected one rate hike this year. Treasury yields moved higher across the curve, with the 10-year at 4.38%. That's not a friendly environment for long-duration growth stocks. The AI and semiconductor narrative is interesting. On one hand, headlines say the party goes on, and the capex boom is broadening beyond AI, which is good for stocks. But tech stocks just had one of their worst weeks in a year, and there's a clear worry that AI momentum is running into reality. The market is asking whether the massive spending on AI infrastructure is going to deliver returns anytime soon, and that uncertainty is weighing on the names that led the rally. Now, stepping back from the weekly noise, this is exactly the kind of environment where long-term investors need to separate signal from noise. A 5% drop in the Nasdaq in a week feels dramatic, but it often reflects a repricing of expectations rather than a fundamental change in business quality. When a sector gets crowded and valuations stretch, any hint of disappointment, a hawkish Fed, a tariff threat, a guidance miss, can trigger a sharp move. But those moves can also create opportunities if the underlying business is still growing. The key question is whether the sell-off is justified by a real deterioration in earnings power or just a shift in sentiment. If a company's competitive advantage, cash flows, and long-term demand drivers are intact, a weekly drawdown might be a buying opportunity, not a reason to panic. So this week, we're going to walk through several stocks that made big moves, both up and down, and judge whether the market's reaction made sense. We'll look at the numbers, the narrative, and the valuation to see if the price change reflects a real change in the business or just a temporary overreaction. Stock number 1. BellRing Brands, ticker BRBR. This name surged more than 21% this week, making it one of the biggest movers in the market. Over the past month, the stock is up about 34%, but zooming out to 1 year paints a very different picture. Shares are down nearly 80%. That context matters. So what drove this week's spike? Volume was more than double the average, and the stock absolutely crushed its sector. Consumer defensive was actually down almost 1% for the week, so BellRing beat that by more than 22 percentage points. The headlines point to a classic relief rally. A Zacks article from Friday noted the stock settled at around $11.50, up 1.4% despite a slipping broader market. Just 2 weeks earlier, the same source had the stock at roughly $8.80. So this looks like a beaten-down name catching a bid, not a sudden fundamental turnaround. The company's trailing PE ratio sits at about 7 times. The MarketSnap model puts fair value in the neighborhood of $14, meaning the stock around $12 today still has maybe 17% upside if the model's assumptions hold. But those assumptions shift a lot with growth and discount rate changes, so take that ballpark with a grain of salt. The model also shows a base 5-year CAGR of roughly 3%. Not exactly explosive. Was the move deserved? In a vacuum, a 21% weekly pop for a name trading at 7 times earnings with positive free cash flow of about $250 million isn't crazy. But the 1-year chart is brutal, and one strong week doesn't erase that. Watch for earnings and any commentary on demand trends. If the rally isn't backed by actual revenue or margin improvement, gains could fade fast. Stock number 2, ASML Holding NV, ticker ASML. This was the biggest loser in our big cap watch this week, down 8.1%. That's a sharp drop for a name that's still up more than 120% over the past year. So let's unpack what spooked the market. The catalyst was a familiar one: China export scrutiny. Multiple reports from June 19th detailed that U.S. Commerce Secretary Howard Lutnick raised concerns with ASML's senior executives that one of its top-of-the-line EUV lithography machines may have ended up in China, which would violate export restrictions. ASML has pushed back, saying none of its EUV machines are in China. Still, the uncertainty weighed on the stock, and it underperformed the broader technology sector by about 5 percentage points this week. The sector itself was down roughly 3%. Now, the fundamentals here still look solid. ASML's latest annual free cash flow came in at over $10.5 billion. The PE ratio is around 64 times trailing earnings, which is premium. But this is a monopoly on advanced chip-making tools. The MarketSnap model puts fair value somewhere north of $2,100, while the stock is around $1,800. That suggests maybe 15% upside from here, though the base 5-year CAGR is roughly 1%, meaning the model sees limited compounding if growth slows. And as always, swing the growth or discount assumptions, and that fair value moves a lot. Was the 8% drop deserved? Probably not entirely. The company is denying the EUV breach, and the long-term AI-driven demand story remains intact. But any whiff of China restrictions hits this stock hard. What to watch next? 1. Any official confirmation or denial from the U.S. government on the EUV claim. 2. ASML's next order book update, which will show if demand from chipmakers like TSMC and Intel remains on track. If the China concern fades, this could bounce quickly. If it escalates, expect more volatility. Stock number 3, CoreWeave Inc., ticker CRWV. This was the week the AI infrastructure story hit a wall. Shares tumbled 18.9%, making it the biggest loser in our weekly recap. The sell-off was severe even by tech standards. The broader technology sector fell just 3.2%, meaning CoreWeave underperformed by nearly 16 percentage points. So what went wrong? The headlines tell a messy story. The company was added to the Nasdaq 100 this week, which normally brings mechanical buying pressure. Instead, a Fool.com article highlighted that CoreWeave has burned about $7.3 billion in free cash flow in the latest fiscal year. Backlog, contracted revenue, is separate and is not cash burn. The trailing PE ratio is negative 37.9 times, which makes sense when you're burning cash at this rate. Insider sales also grabbed attention, with headlines about insiders dumping billions. There was a brief bounce Thursday after Micron's strong earnings lifted AI sentiment, but it didn't stick. Our MarketSnap model currently puts fair value around $70, with the stock trading near $95. That implies a gap of maybe 30% downside from here. The model's base 5-year CAGR is roughly negative 7%. But as always, those numbers swing heavily if you change the growth or discount assumptions. Was the move deserved? In my take, yes. The cash burn is staggering, and the backlog narrative, $100 billion in contracted revenue, doesn't change the fact that they're spending faster than they're collecting. Insider selling at these levels is rarely a vote of confidence. What to watch next? First, any news on debt refinancing or capital raises. The cash burn rate isn't sustainable. Second, whether the Nasdaq 100 inclusion actually creates lasting demand or was just a one-day event. If the cash flow story doesn't improve, this stock could test its 52-week low of around $64. Stock number 4, NVIDIA Corporation, ticker NVDA. This one took a hit this week, falling 8.9%. Over the past month, it's down 10.4%, though it's still up 24.2% over the last year. So what caused the sell-off? A few headlines piled on. One story highlighted that everyone from OpenAI to SpaceX is building their own chips, turning up the heat on NVIDIA. Another piece noted that Cerebrus's raw speed is still falling into NVIDIA's massive software trap, suggesting competitive pressure is real, but NVIDIA's ecosystem remains a moat. There was also news that Jensen Huang admitted NVIDIA's China revenue has fallen to zero, with a $20 billion comeback plan centered on new Vera CPUs. That China revenue uncertainty clearly spooked some traders. The stock underperformed its sector by about 5.8 percentage points, as the tech sector fell a more modest 3.2%. Despite the weekly drop, the fundamentals still look solid. NVIDIA's trailing PE ratio sits around 32 times earnings, and the company generated nearly $97 billion in annual free cash flow. That is not a cash burn story. Our MarketSnap model puts fair value roughly around $260, while the stock sits near $190. That suggests maybe 35% upside from here. The base 5-year CAGR estimate is around 4%, but remember those numbers shift a lot depending on growth and discount assumptions. Was the move deserved? It feels like an overreaction. The headlines about custom chips in China are real risks, but NVIDIA's software lock-in and upcoming Rubin upgrade cycle are powerful offsets. The stock hasn't been this cheap in years, according to some analysts. What to watch next? Keep an eye on the Vera CPU ramp and any updates on China export policy. Also, watch for signs that custom chip competitors like Cerebrus or Qualcomm are actually taking share, not just generating headlines. That wraps up this week's MarketSnap. BellRing Brands jumped more than 20% in what looks more like a relief rally than a confirmed turnaround. ASML dropped 8.1%, but its fundamentals remain intact. CoreWeave fell 18.9% on a business concern, and NVIDIA was down 8.9%, with fundamentals still solid. These are not buy or sell recommendations. Use them as a watch list for your own research. Check the description for links to the MarketSnap screener and intrinsic value tools. Thanks for watching.